Welcome, dear traders. You are watching a recap of the Asian session on October 4. Stock indexes in Japan, Australia and other countries in the region hit multi-month lows after Wall Street's plunge on Tuesday. The world's bond markets are in the throes of another bout. At the same time, US government bond yields have hit a 16-year highs, putting even more pressure on the stock prices. The appetite for risky assets is waning for several reasons, mainly on the news from the United States. First of all, the US economy continues to show robust indicators. For example, yesterday's JOLTS report came in stronger than expected. This was another factor in favor of the Fed's hawkish policy. The US regulator can keep interest rates high for a long time and forget about a recession risk against the backdrop of a strong labor market. Markets also turned their attention to the political drama unfolding in the US Congress. For the first time in the country's history, the Speaker of the House of Representatives was removed from office by a vote. Moreover, Kevin McCarthy was ousted on the initiative of his fellow Republicans. At the same time, the election of a new Speaker of the House may become very difficult. This is especially true given the threat of a government shutdown. There are just over 40 days left in this Congress. Against this backdrop, US government bonds are selling off. Investors are putting money into the US dollar with the yields at multi-year highs. Federal Reserve officials do not seem alarmed by the sharp rise in the long-term US Treasury yields. While the political drama in the Congress is gaining momentum, the currency market are just watching the unfolding events. The US currency has soared to new heights with a jump in the Treasury yields. In addition, the US dollar surge is fueled by the national economy withstanding high interest rates. As a result, after yesterday's strong report on the labor market, the US dollar index outperformed its counterparts from the G6 basket of currencies. The US currency was resting on its laurels at the beginning of Wednesday. However, its rally has so far faced decent resistance as the markets began to consolidate ahead of Friday's employment report. The greenback began to consolidate near 107.10 as investors awaited the economic data. In Asian trading, the US currency was down in the range of 106.90 to 107.20. The decline in the US dollar can be linked to the Japanese yen. On the chart, the Japanese currency went sharply lower at the beginning of Wednesday. As a result, its price tested the support level of 148.75. However, bulls managed to cancel the downtrend in the Asian session. The fragile yen continued to hover near its 11-month highs in the range of 148.70 and 149.30. For several months, the dollar-yen pair has been trading close to the level where the Japanese regulator intervened in the market to keep the yen from falling further. It's possible that today's decline is the result of such intervention. Tokyo has yet to make any statements on this. At the same time, Japanese monetary officials also refrained from their daily verbal interventions. However, even if Japan's intervention in the currency market took place, its results were short-lived. Moreover, the situation looks very similar to September 2022. At the time, the first round of intervention worked poorly, and the Bank of Japan had to part with some more of its US dollar reserves. The country's authorities may send an even more aggressive signal to support the national currency. Otherwise, the dollar-yen pair may approach the October 2022 high of 152 against the stronger US currency. The antipodium currency strengthened against the weaker greenback. In addition, the US dollar eased pressure on oil prices. As a result, commodity assets benefited. Meanwhile, the Aussie managed to bounce from its 11-month lows and rose above 0.6320 in Asian trading. Yesterday, the Reserve Bank of Australia left the interest rate unchanged. At the same time, the Australian dollar received support from foreign data. Early Wednesday, the Aussie took advantage of a bullish support and moved higher in the range of 0.6287 and 0.6327 on the daily chart. The meeting of the Reserve Bank of New Zealand was held today before the country's currency followed its Australian counterpart at a slightly accelerated pace. After the central bank left its rate unchanged, the Kiwi initially touched its 11-month lows in the area of 0.5870. After that, the Kiwi soared within the range of 0.5871 and 0.5923. As a result, the Kiwi dollar pair inched higher in the Asian session to the psychological level of 0.5900. However, it was remaining in the bearish territory. Emerging markets bonds in Asia also saw heavy selling pressure today. At the same time, the Indian rupee held near significant lows. At one point, the rupee tested 83.26 against the US dollar. However, the Indian currency strengthened slightly against the greenback as the central bank tried to resist the almighty US dollar and protect the domestic market. The euro-rupee pair fell to 87.20 from 87.40 at the beginning of October. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. So subscribe to our channel and see you online soon.